Welcome to the Deep Dive. We're your shortcut to understanding the market moves that really count.
And today, we are definitely digging into one of those moves.
Yeah, we're tearing into the Q3 2025 earnings call for Vital Farms. And just looking at the market reaction this morning.
Oh, it was big. This wasn't just, a decent quarter. It felt like a statement.
A major statement. They beat expectations pretty much everywhere and significantly boosted their outlook for the rest of the year.
Exactly. It showed what investors love to see. Clean execution, strong financials, and management sounding really confident. This is about way more than just eggs. It's about proving they can scale this premium model.
Right. So our mission today is simple. Boil down that conference call, the slides, everything, into the key takeaways you actually need.
We'll hit the financial beats, the crucial operational steps they took, and sort of translate what management was really signaling.
Okay, let's dive right in. The headline numbers, where did they land?
Well, the financials really set the stage. GAAP EPS, $0.36.
$0.30.
Yeah.
And consensus was hovering around 30 cents, right?
Yeah, around 30 cents. So a really significant beat there. Straight away, that tells you something's clicking on the margin side.
And the top line followed suit.
Absolutely. Record revenue, $198.9 million.
Wow. What was the street looking for? Like 190 something?
Consensus was kind of in the $191 to $196 million range, so they cleared even the high end of that.
That translates to what, over 37% year-over-year growth?
37.2% growth, yeah. Really strong momentum.
But growth can sometimes cost you on the profit side. How did margins look?
That's the key point here. The growth wasn't, bought with deep discounts. Gross margin actually went up.
Up how much?
Came in at 37.7%. That's an 80 basis point improvement compared to last year.
So for every dollar in sales, they kept almost an extra cent in profit compared to Q3 last year.
Exactly. And importantly, that 37.7% is still sitting comfortably above their long-term goal, which is around 35%.
Okay, so that efficiency must have flowed straight down.
Yeah.
What about adjusted EBITDA?
It really did. Adjusted EBITDA, which gives you a good sense of core operating profit, hit $27.4 million.
$27.4 million. How does that compare to last year?
Get this. It's an 81% increase from the same quarter last year. 81%.
Wow. So profit grew way faster than revenue? That's serious leverage.
Huge leverage. Delivered a really healthy 13.8% adjusted EBITDA margin.
And when you see that kind of performance, beating on revenue, beating on EPS, expanding margins, and raising guidance all at once.
The market notices. That big positive jump in the stock price pre-market wasn't random. It was a direct response to this clean beat and raise. Investors are clearly buying into the execution story.
Okay, let's unpack that execution. The CEO kept talking about disciplined execution. What were the big operational wins this quarter that made these numbers possible?
Well, number one was just getting more supply online. They have this complex network of family farms, right?
Yeah.
They added about 75 more farms just in Q3.
75.
In
3 months.
Yep. Brings the total to 575 farms. And they mentioned having over 10 million hens under contract now. That's a huge scaling effort.
Okay, so more eggs coming in.
Mm-hmm.
But you need to process them. What about capacity there?
That was the other big piece. They finally commissioned the third production line at their main facility, Egg Central Station ECS in Springfield.
Line 3 is live. When did that happen?
Came online right at the start of Q4 in October. And this is a big deal for capacity.
How big?
Management said this expansion boosts their total processing capacity to support something like $1.2 billion in annual egg revenue.
$1.2 billion. That's a lot of runway.
It is. And they mentioned this third line is a bit smaller, designed for shorter runs, specialty stuff.
So it frees up the main lines for the big sellers.
Exactly. Lets lines 1 and 2 focus on the high volume products, making the whole system more efficient.
Okay, physical expansion makes sense. But you also mentioned digital, the ERP system.
Yes, and this is where, you really see the execution chops. They went live with a major upgrade to their core ERP system. That's the software running everything from inventory to finance.
ERP upgrades are notoriously painful. Things often go sideways.
They really are. It's high risk. And management was upfront about it. They said it caused a planned slowdown in production for the first couple of weeks of Q4.
Planned slowdown, okay.
But here's the kicker. They pulled off this complex digital switchover while launching the new physical production line and delivering those record Q3 results.
That's actually kind of amazing. Speaks volumes.
It really does. They said they bounced right back to normal shipment levels after those first 2 weeks, and importantly, that temporary dip was already baked into the guidance they just raised.
So they anticipated the disruption, managed it, and still felt confident enough to raise their targets.
Textbook execution on a very tricky set of projects.
And financially, they're set up to keep investing, right? Balance sheet looks clean.
Super clean. About $145 million in cash and securities, and crucially, zero debt. Lots of flexibility there.
Any update on that Meyer internal control issue they flagged before?
Yeah, they touched on that, just reiterated it was a design deficiency and no impact on past numbers. And they're on track to fix it by year end. Apparently, the fix involves controls in the new ERP system, so it all ties together. Seems like top-notch financial housekeeping.
Okay, let's pivot to the guidance, because that's really what lit the fuse under the stock. They didn't just nudge it up, did they?
No, it was a substantial raise, really signaled confidence for Q4 and beyond.
So these specifics, revenue outlook first.
They raised the full year 2025 net revenue guidance. Now they're saying at least $775 million. That's up from their previous outlook of greater than or equal to $770 million.
Okay, a solid bump. And profitability, adjusted EBITDA.
That got a bigger boost, now targeting at least $115 million for the year, up from greater than or equal to $110 million before. So they're finding more profit dollars, even while acknowledging things like higher Q4 promotions and that brief ERP dip.
Interestingly, though, they actually cut their planned capital spending for the year, right, by about $10 million.
He did. CapEx guidance is now $80 to $100 million. Down from $90 to $110 million.
Is that a sign of slowing down investment?
Management was clear. No, it's not project cuts. It's just shifting the timing of some spending into 2026, optimizing when they deploy the capital.
Makes sense. And it all feeds into that huge new facility they're building in Seymour, Indiana.
Exactly. And they reiterated that incredible metric for Seymour. Every single dollar they invest in capital expenditure there is expected to generate $5 in annual revenue capacity.
$5 of revenue for every dollar of CapEx. That's a powerful engine.
It's the core of their argument for reaching that big long-term goal, $1 billion in net revenue by 2027.
Right, driven by Seymour coming online, plus continued growth in the farm network.
Yep. Seymour alone is expected to add something like $900 million in annual revenue capacity when it's fully ramped. They're building the infrastructure ahead of the demand curve.
Okay, let's shift to the Q&A on the call. Analysts often dig into the why behind the numbers. What were the key points there? They definitely pushed on that big volume growth, right? 19% in Q3.
They did. The question was basically, is this real demand, or are you just stuffing retailer warehouses after being short on supply earlier?
The answer was?
Management was pretty forceful. They argued it is sustainable consumer demand. They insisted the demand was there all along, especially first half of the year, but they were bottlenecked.
So now, with the extra farms in ECS Line 3, they can finally meet the demand that was already waiting.
That's the argument. Filling shopping carts, not just back rooms.
Okay, so if demand is strong, how do they grow from here? They're already in, 24,000 stores? Are they just adding more locations?
That was another key clarification. They said, no, the focus isn't primarily on adding more doors anymore.
So what is it then?
It's about adding more items, more SKUs within those existing 24,000 stores.
Ah, so getting more shelf space with products like maybe liquid eggs, butter, different pack sizes?
Exactly that. They're leveraging their growing brand awareness, which they said is up 8 points year over year to 33%, to convince retailers to carry a wider range of Vital Farms products.
That makes sense. Capital efficient growth, focusing on deeper penetration rather than broader reach.
Precisely. And they also mentioned a nice tailwind from their organic products growing faster, which helps the overall product mix and margins.
They also talked about planning for higher promotional spending, trade spend, in Q4. Did analysts push back on whether that was a defensive move?
Yeah, there was some questioning around that, but management positioned it very intentionally.
How so?
They said the higher Q4 promotional spend isn't about reacting to price gaps or trying to clear inventory. It's specifically timed to drive trial and acquire new customers now that they finally have the supply capacity from ECS Line 3 to support that growth.
So use promotions strategically to get people to try the brand, banking on them sticking around.
That's the plan. They believe the brand's values and trust resonate, making customers less price sensitive once acquired.
Speaking of price, they did acknowledge the price gap between their eggs and conventional ones has widened. Any concern about consumers trading down?
Management expressed confidence here, maybe bordering on optimistic. Their view is that their core customer buys based on values, trust, transparency factors that make demand less elastic, less sensitive to price swings compared to commodity eggs.
The Q3 numbers certainly back that up, strong volume despite higher relative prices, but it's something to watch in Q4, especially with those promotions.
Definitely something to keep an eye on, see if that holds true as economic conditions evolve.
One last thing on cost shipping. Did they mention anything there?
Yeah, they actually got a bit of a tailwind in Q3. Favorable macro conditions. Basically, there was a surplus of trucking capacity, which pushed down freight rates, so their distribution costs were lower than expected.
But they don't expect that to last.
No, they cautioned that Q4 unit costs for shipping will likely tick up sequentially, partly seasonal, holiday rates, but they still expect Q4 shipping costs per unit to be better than they were way back in Q1. So manageable, not a major structural headwind.
Okay, great summary. We've got the numbers, the operations, the strategy, the Q&A context. Let's transition now.
All right, and before we go further, the standard but very important disclaimer. This next bit is purely for discussion and education. It is absolutely not financial advice.
Definitely not. We aren't telling you to buy or sell anything. Please don't. We're just exploring a hypothetical scenario based on everything we've just discussed.
Consider it a thought experiment. So, with that out of the way, let's talk about an outrageous but plausible trade idea.
Okay. Given that incredible operational leverage, again, that 81% EBITDA growth, and seeing them actually deliver on complex projects like ECS Line 3 and the ERP, there's a structural story emerging.
A story about taking market share consistently. Exactly. So, the trade idea. Go long Vital Farms, Vital betting they keep executing this supply chain build-out, and pair that with a short position on an established, maybe slower growth conventional CPG company.
Which kind of CPG?
Maybe one heavily exposed to commodity ag inputs like conventional eggs, or maybe one struggling in premium categories where Vital Farms is winning.
Okay, why the pair? Why not just long Vital?
Because the pair trade isolates the bet on Vital Farms' specific structural advantage, that $5 of annual revenue for every $1 of capex in the new facility.
Right, you're betting that that engine lets them consistently outgrow and take share from incumbents who can't match their model or meet that specific consumer demand for ethical, transparent production.
Precisely. Many traditional CPGs are fighting slowing growth, maybe relying more on promotions just to hold share in commodity-linked areas. Vital Farms seems to be building a different kind of machine.
So the bet is essentially that the execution credibility they just demonstrated, getting Line 3 up, navigating the ERP, significantly de-risks their path to that $1 billion target by 2027. And that growth comes at the expense of others.
That's the core idea. The biggest risk used to be, can they actually build it? Now it feels more like, how fast can they build it? Of course, big risks remain a major stumble on the Seymour facility build-out, or a really deep recession hitting premium demand hard.
But the thesis rests on their proven ability to execute complex plans now.
Execution credibility is arguably higher than it's ever been for them.
Okay, that was definitely a deep dive. Let's quickly recap the highlights from this Vital Farms call.
Record revenue, first off. Huge margin expansion, showing that scale is really working for them.
Significantly raised guidance for the full year, signaling strong confidence.
And maybe most importantly, clear proof of operational execution, expanding the farm network, bringing ECS Line 3 online successfully, and navigating that tricky ERP transition.
The takeaway feels pretty clear. They managed through a really complex phase, and now seem set up to capitalize on strong, sustained demand.
Agreed. They seem to have built the engine and are now focused on fueling it.
And one final thought, maybe something for you, the listener, to chew on. The CEO pointed out their brand still has less than 3% of the total U.S. egg volume, just under 3%.
Tiny, really, in the grand scheme of the egg market.
So if they keep executing on capacity, keep building that brand awareness, what percentage of the total U.S. egg market could realistically shift to premium ethical producers like Vital Farms long term? Could it be 10%, 15%, more?
And if they capture even a slice like that, what does that imply for their potential market value down the road?
Something to think about. The scale could be quite significant.
A fascinating question, given how well they seem to be operating right now.
Indeed. Thanks for joining us for this deep dive. We'll catch you on the next one.